Look, we blew through 2000, never challenged it. Blew through 3000, never challenged it. Blew through 4000, still haven't challenged it. We may, but as we said, support a step back in. But when you follow the narrative, the conventional wisdom of the mainstream, and some of what they say is legit based upon what I just said, and blowing through these averages, 50, 70, $100 a day moves, that's unprecedented to the upside. But when we look at what happened in the middle of the evening last night, where in the thinnest part of the trading cycle, when New York is fast asleep, someone or some entity or a coordinated effort dumped a massive wave of futures contract onto the market. Again, when New York was fast asleep, this drove silver under $50. It knocked gold down $100. But then something interesting happened. I mean, this was shock and awe, Michelle. This is a drive-by shooting, right? Any trader that would be stupid enough to dump that level of futures onto the market at the thinnest trading segment of the day, when there's virtually no liquidity, would be fired and shot, and probably not in that order. And it was specifically done for effect. But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes, but someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. The interesting part about that is it was a month ago where the chief investment officer for Morgan Stanley came out and said, yeah, you know, the 60-40 mantra we've been talking about for so long, we think we should sell 20% of the bonds, 60-40 being the Wall Street steadfast way of investing, 60% stock, 40% bond. He says, no, let's do 60-20-20, 20% bond, 20% gold. Well, Michael believes that there are footprints of Morgan Stanley and Bank of America, whose high price analyst, Michael Hartnett, whose newsletter I believe is at least $10,000 a year, only speaking to the institutional traders, came out and said, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. Bank of America last week raised their target on silver to over $66 or $67 for next year, with an interim price, medium price between now and then, or an average price of somewhere around 57. He goes on to talk about that since October 17th, 6,000 new immediate delivery contracts were written, which is all but a record for this late stage of the delivery cycle. And he goes on to say, if the pace continues, it could be one of the biggest delivery months ever on record, challenging the February and March deliveries. So in other words, the market got bombed by paper in the middle of the night when no one is trading and New York is asleep, which provides all the liquidity. But yet someone came in and gobbled a whole bunch up. And at the same time, we saw 11,000 paper long contracts closed out. So this is a very unusual drive-by shooting for effect type of sell-off, yet some of the fundamentals that are cited by the mainstream are true. It's a half truth. Yeah, those things are true, and the markets can stay overbought for a long period of time. But to ignore how the sell-off occurred and just simply say this is profit taking is ridiculous. It's just not good reporting, is what it is, because any normal trader would have spread that out during the most liquid time of the day in New York trading over hours or even days to maximize that level of return, not dump it on for effect. And that's exactly what happened. And I think that is something that should be taken into consideration as we continue to talk about what's going on.
Well, for sure. But I think we need to break down what you said there. So what did you mean by in the middle of the night there was a paper dump? Break that down, explain in as much non-technical detail what exactly that would mean and how that would drive the prices down.
Well, it would have been, in the access market, could have been in between. It was probably in between the closing of Asia and the opening of London, somewhere in that period of time where the main price setting is done in New York. The traders who would provide the liquidity, the big banks, would be found in New York City. And if you are going to execute a trade, you don't. If you wanted to sell $25 million worth of a stock in a thinly traded market, you don't just dump it onto the market to cascade the price and get the worst settlement. You would do it over time, slowly, maybe through multiple entities, not trying to spook the market, but dumping it into a market that is thinly traded, meaning not in New York and not even when London is fully operational, or right as China is closing. You're talking very few players are providing liquidity. It is going to provide the worst possible settlement you could possibly get. It's done for effect. It would not be the way that any trader with half a brain cell would ever try to maximize return for their client or for their own position. And it is specifically done to drive down the paper price.
Okay, so you did mention though that Bank of America purchased some of this. We know this
Yeah,
definitively, but
Michael
then
Lynch said. Michael
right.
Lynch says that Bank of America and Morgan Stanley, which had been dormant for a long time, or actually net sellers, flipped from selling. And he believes that they are two of the largest purchasers that came in and snapped this up. Now, a lot of this is he has a way of figuring it out. And I think everyone should check him out, read him on his Substack and on X. He does a great job of analyzing the inflows and the outflows and who's buying and who's selling. But the bottom line is, I think what we take away from this is that there were some big players who scooped up. And is it scooping up physical to cover short positions below 50, below moving averages, or at least below trend lines? And I think that's actually possible, because what we see is the buying of, in the last 3 days, by Morgan Stanley, 196,200 ounces, by his estimation, in the last 3 days of gold. So, when you talk about knocking the paper price down to create the lowest or worst possible settlement to drive the price down, and then buyers coming in to scoop up, I mean, that just reeks of coordination, of suppression, of a ulterior motive, rather than doing it the way any normal person would do, and that would be to slowly sell your position to maximize the return instead of the antithesis, what we saw.